Good morning student. I am Dr. Ibha Rani. In this video, I will be discussing about the Dow Theory. Dow Theory, it is a trading approach developed by Charles Dow. It is fundamental theory of technical analysis and it has been developed by Charles Dow in the 19th century. This theory is based on the idea that the stock market is made up of three distinct trends. It is basis of technical analysis of financial market, and as per this theory, the stock market or any market does not move in straight line, but it will go from high to low. With overall moves of market, it will be trend in a directions. The direction can be upward or downward trend, it will be followed. But this theory is made up of six principles. Based on the six principles, this is also known as basic tenets of the Dow theory. So this now I will be discussing about the basic tenets of Dow theory. The first tenets of the Dow theory is the averages discount everything. It means that the idea that the market reflect every possible information or factors which can affect the overall supply and demand if it is on the basis of premises of the technical theory. So whatever the information it is happening all around the economy, in industry and in company, it is reflected in the price of the stock. So the first tenet of the Dow theory is the average discount everything. The second theory is talking about the market has three trends. The three basic trends, the market has three distinct trends it will go. This theory is based on the idea the stock market is made up of three distinct trends that by analyzing these trends, trader or investor can predict future price movement and can make profitable trades. The first trend is the primary trend. So here primary trend is the long-term trend of the market, and this trend can last for several years as it is a long-term trend, so it will be lasting for several years, and it is often referred to as a bull market or a bear market. It means that market is increasing, it will be bull market, and if the market indices is decreasing trend, then it will reflect in the bear market depending on the whether the prices are rising or falling. So the primary trend is the most important trend to follow as it determines the overall direction of the market. So this primary trend will reflect the market as bull market or bear market, and it is similar to that the tide of the ocean. The second trend is the secondary trend, which is shorter compared to the primary trend, and it can last from a few weeks to month. Generally from weeks to month it will be running, and it is considered as similar to the wave, how the wave in the ocean, the same way the market will reflect in the wave. And it is this trend is also referred to as correction in a market. So whenever there will be like the market will move in upward, then you can see suddenly the market will be downward. It is known as the market is correcting itself. It is the correction mode. They move in the opposite direction of the primary trend. For example, in a primary bullish market, you can see bearish secondary trend for a few weeks before the market picks up again. So this is known as the secondary trend, and it is similar to the wave. The last trend in the market is the minor. This is the minor. The name itself it is showing. It is the shortest term trend. It may be day-to-day fluctuation in the market. It will be reflected in the minor trend. This trend is often caused by short-term fluctuation in the market, day-to-day fluctuation in the market, and it will be difficult to predict the minor trend. However, it is still important to watch for as it can provide opportunities for trader to make a quick profit. Now the third tenet of the Dow theory is major trends have three pages. First the market was having three trends, and now the major trends means long-term directions, long-term movement of the market will go through the three different phases. The first one is accumulation phase, second one is public participation phase, and third one is distribution phase. So first I will be discussing about the accumulation phase. This phase generally occurs right after a steep downtrend, during which many investors and traders lose hope of the price will be rising upward in future. So the price may have touched the lowest possible point for the cycle. Buyers remains hesitant to purchase. In this period, the buyers will be hesitant to purchase the stock. Because of this, the price of the stock contributes the stagnate at low level. Means it will be continue, the price will be stagnant, it will be low, it will be for the longer period of time. At this point, the smart investors, smart means technical institutional investors, will start entering into the market as the price is low. They recognize that the market has touched a low and a bid to accumulate the stock at such low prices. They will start purchasing those shares, those stocks, and they will be purchasing at large volume. As they are institutional investors, they will be purchasing the large volume stock regularly over a prolonged period of time. As the volume of stock purchased by these smart institutional investors, it will kickstart the sluggish demand and gives the stock price a much needed upward push. So here in this accumulation phase, mainly the smart institutional investors will start investing in this phase. Next will be public participation phase. It is also known as the response phase. Response means public distribution phase is when short-term traders who follow only the technical trends notices that the activities which are taking place and start entering into the market. They begin buying the stock as well. It will be rise in the price of this set. In this manner, a bullish trend is established. It is why, because this is also known as the markup phase. It is the analyst and researchers see high price trend in this phase. So this will be and eventually increases the public participation in this phase. So it will be accumulation phase, then it will be the public participation phase. The next and last phase of the major trend is distribution phase. At the peak of the markup phase, the price of the stock reaches new high levels. As news of these trends become more, the information is publicly available, everybody will begins to invest in the stock. Here is where the smart investors, the institutional investors who have purchased the stocks in accumulation phase, start selling in this phase. And then institutional investors start to sell off their holdings systematically, and they do so when others in the markets are focused on buying. So during the accumulation phase, smart money investors are buying up stock before the general public catches on. During the public participation phase, the general public begins to buy in, driving prices up, and during the distribution phase, smart money investors begin to sell off their shares to lock in profits, and the trend start to reverse. So this is the third tenets of the Dow theory. Major trends have three phases: accumulation, public participation, and distribution phase. The fourth tenets of the Dow theory is the average must confirm each other. Here averages must confirm each other means it means that the signal that occur in one index must match or correspond with the signals on the others. So for example, in India we have CNXX, Nifty, NSE. It is primary move, maybe it is in upward directions, but Nifty 500, that is Nifty mid cap, and other major indices in the market are moving downward. It means that it is not confirming each other. As the Nifty NSE is moving up instead, only when all the indices move in the same directions, then only you can identify that the trend concretely according to the Dow theory. So means if one indices is upward, others also should go upward, so that you can confirm that now it is upward trend or vice versa. So the averages must confirm each other. The fifth one is volume must confirm the trend. Volume increases or decreases according to whether the price is moving in direction of trend or in reverse trend. Dow considered volume a secondary indicator. The first indicator is the price, and he has considered the secondary indicator is the volume. His buy or sell signal were based on the closing price of the stocks. For example, a market phase where the prices are on the rise, in order to classify this as a bullish market, the trading volume should increase. When the prices go up, it is a primary trend. It will be fall when the prices are goes down. So this will be, since it is a thing, so it will be the volume will confirm, must confirm the trend. And the last tenet of the Dow theory is trend is assumed to be continuous until definite signal of the reversal. So it means that the overall technical approach in the market analysis is based upon the idea that trends will continue in motion until there is an external force causing it to change its directions, just like any other physical objects. Charles Dow recognized that it is easy to confuse secondary trend with trend reversal, but this is because both these price movement move in the directions that's opposite to the primary trend. For example, say the market is now primarily bearish in nature or falling downward. A temporary upswing may seem like a trend reversal, but then again it could also just a secondary trend. So the Dow theory says you will have to continue to consider the market as bearish even with a temporary upswing until it is clear that the upward movement is established. It would be a trend reversal, making the market bullish. So the conclusion is the Dow theory is a powerful tool for traders or investors who want to inform trading decisions. By analyzing these trends of market, trader or investor can predict future price movement and make a profitable trades. However, it is important to remember that no trading strategy is foolproof and that trader must always exercise precautions and do their own research before making any trades. So quick recap of the tenets of the Dow theory. There are 6 basic tenets of Dow theory. The first one is market discount everything. The second was the market has 3 trends: primary, secondary and minor. The third tenet was the market trends have 3 phases: accumulation, public participation and distribution. And according to fourth tenet, the indices must confirm each other for a trend to be established. The fifth was the trading volume must confirm with the price trend. And the last is trend persists until there is a clear reversal. So I hope you understood the Dow theory. Thank you all.